everyone, and welcome to another episode of IFS Ask the Expert, where we ask your burning current financial questions to one of our in-house specialists or specialist partners.
Hi guys, as always, thank you so much for your questions this quarter. As requested, let's start with a quick equity market review of 2023 so far, and then I'll get on to answering your questions as best as I can. If I was to sum up in one word 2023 market conditions, the word I would use would be volatile. We had a really positive and encouraging start to the year with widespread gains in January. However, performance became more muted as the quarter progressed. Why? This was mainly due to the collapse of Silicon Valley Bank and of course the rescue of Credit Suisse by UBS. This firstly unnerved investors as the media reported the potential for global financial crisis part 2, and of course this was coupled by central banks restating their intentions to continue to increase interest rates to combat inflation. So you had this perfect storm, if you will. So the knock-on effect was a mixed bag of returns. So perversely we saw renewed interest in the tech sector. And if you look at the Nasdaq, which is the tech-laden US equity index, this surged over 20%. Why? Well, the Nasdaq was down over 33% last year, so many traders were expecting a bounce in Q1. But also short-term traders bet on this potential banking crisis to force central banks to stop raising interest rates due to the obvious pressure this was putting on the banking sector. Why is this important for tech? Well, we've discussed this in previous videos. Tech stocks and growth stocks in general often are valued on future earnings potential rather than their current earnings. So growth stocks or tech stocks are very sensitive to interest rate changes. Therefore, in an environment of rising interest rates, which is what we've experienced since 2021, these types of stocks may be more susceptible to corrections or to pullbacks as investors reassess their expectations for future earnings growth, of course discounted by higher interest rates. So if this trend is to reverse, i.e. interest rate cuts, then this is seen as a positive for growth in tech stocks. So some of our biggest contributors to performance in the New Horizon strategies in Q1 were the Nasdaq and innovative tech megatrends. In contrast, the Dow Jones Industrial Average, which includes more of your traditional sectors and traditional stocks, this only just scraped back into positive territory at the end of March amid concerns of contagion from the banking crisis. Moving over to Europe, shares in most European markets also rallied during the quarter on improving economic fortunes as the Eurozone overcame its dependence on Russian gas, and of course this was during a much milder winter than usual. However, the demise of Credit Suisse dampened this investor confidence, and in the UK especially, where banking is a particularly important market sector, the FTSE All-Share Index declined 2.8% in March alone. Moving on to emerging markets, and in particular Chinese equities do not seem to have factored in the improving economic fortunes of the world's largest economy. The SSE Composite Index, which is a useful benchmark for Chinese equities, that gained around 5.9% during the quarter, but this retreated around 5% in March. Meanwhile, the SSE Index for India is down 7% on the year. So overall, Q1 was very positive for some equity markets and some sectors. But look, as we can see from this particular chart here, if we focus on the US equity sectors, but it's much the same as in Europe, economically sensitive sectors such as real estate, as you can see from these lines, banking, oil and gas, were all down around 5 to 10%. So what seems to have happened to a certain extent, inflation is no longer the buzzword, which could explain a bounce in tech as traders now believe interest rates have peaked. Instead, the market is now focusing on the economy and the potential risks of a recession.
Thanks everyone for watching another IFS Ask the Expert. Please remember to like, subscribe or bookmark this page so that you don't miss the future episodes. If you have any questions about the topics, please feel free to contact your wealth manager or contact us below. Of course, please feel free to send us your questions. Thanks and see you next time.